Hello, everyone, and welcome to the Stanford Brown SB Talks podcast, where we explore various elements of life at Stanford Brown, from investments to strategy, from retirement planning to intergenerational wealth. Today is Tuesday, December 8th, and we are again catching up with our Chief Investment Officer, Ashley Owen, to discuss investment markets, economic recoveries, and growing trade tensions. Welcome, Ashley.
Welcome, Vinny, and welcome all wherever in the world you are.
So, Ashley, it's now been over a month since the US election. In fact, this morning we had Georgia recertify their electoral college vote for the third time. And November has been the best month in many years for share markets in Australia and around the world.
So I think November was, our best month in Australia since, I think it was March 88, which was a rebound from the 87 crash. But I was just thinking the other day, in the last year, nothing much has changed really. Shares are exactly what they were last year. Trump's in the White House, he's still there. Scotty from Marketing's in the Lodge and he's still there. So what's really changed? Not much really.
A few things.
A couple of things have changed. The one thing I do watch is that share markets and how they've reacted to the world. I've got a nice little chart in this month's pack where I've got 60 or 80 countries ranked on the stock market this year. Australian shares are pretty much where they were at the start of the year. They've clawed back. They're about halfway down the pack of the 60 countries I cover. They're about number 35 out of 60 countries to come back. US is well ahead. A lot of markets are well ahead. Most of Europe is still below. So Europe has been hit badly by the coronavirus lockdowns. The banking sector is quite big in Europe and the banks have been a dog around the world and Australia as well. So look at the markets which have taken off. US is well ahead. Denmark's well ahead.
I was going to say, who are your stars?
Korea, Taiwan. A lot of the markets which are heavily tech-related or healthcare-related are ahead.
Right.
And Australian market, which is got a very tiny. We've got our Afterpays and WiseTechs, but that's only all of those together, only about 4% of the market. So it's very small. We've got a very small healthcare sector. We've got CSL, which is the biggest stock in Australia, but we've got two or three others, Sonic, Ramsay, etc. But the countries that have done very well in the world this year and over the last 5 years are countries which are heavily tech-related or healthcare-related. So you've got Denmark, for example, which has got two or three of the top biggest 5 stocks are healthcare stocks. US, of course, Samsung in Taiwan and Korea have done very well, whereas other markets in Europe, which are heavily bank-related, industrial-related, consumer spending-related, they're quite low. So Australia's done, our shares are back pretty much to square. Some sectors have done very well. Some sectors have done quite poorly. Oil and gas, for example, banking systems.
So that's square from 12 months ago, not necessarily square from the start of the
start of the year. Start of the year, or start of the crisis. Markets drifted up in January. They drifted down in February.
Positive January and early February before the virus started to spread.
And then we had the big tank in the 4 weeks from the end of Feb to the end of March. And then we've had the steady recovery since then, pretty much around the world and Australia as well. So all of that, despite the fact that Australia has had one of the shallowest recessions or depressions, economic contractions of all countries. If you define a recession as a contraction in incomes, and 70% of the income spent in Australia is household income, 60+%, household incomes have actually gone up because of all the cash raining from the sky from government. So we haven't had a recession at all. Incomes have gone up and spending's gone up in a lot of sectors. At household level, which is which accounts for 2/3 of the total spending pie in Australia. So whereas we've had one of the lowest coronavirus infection and death rates, we're sitting at about 50-odd deaths per million population compared to the US, which is 850-odd deaths per million
you
population.
Put together an interesting chart in your latest monthly report on page 3 where you've done a correlation between countries' experiences with the virus, unfortunately deaths experiences there, and how their markets have performed through this. What correlation did you see there, if any?
Well, like all my charts is a story and they're always too complex, but there's a downward slope, which means that most countries are grouped in terms of high death rates and low stock market returns. Yes. Or low death rates and high stock market returns, like, for example, New Zealand.
Which would be logical.
Which seems to make sense.
Theoretically, you did better at managing the crisis, therefore your economy's been open for longer, therefore your stock market should go better.
Should be.
However,
that's worked.
Nothing's ever that simple.
So most of Europe, for example, is very high death rates per million and very poor stock markets, worse than Australia. The outlier or the exception to all of those rules is the US, which has very high death rates, one of the highest in the world per million population, and very good stock market. And again, it comes down to the makeup of the stock market, which is tech and healthcare. The two biggest sectors now are tech and healthcare. Plus, if you include consumer discretionary, which is dominated by Amazon, that's like a tech stock as well. A lot of the telco sector is now full of things like Google and Netflix and Facebook, which are really tech stocks as well. So if you add those two, the tech sector in America is really like a third of the market or more.
Yes.
And plus healthcare as well, which is another 15% of the market. So that's been very strong.
Sectors that have essentially benefited from the crisis.
They've benefited and they've accelerated trends that were already there.
Yeah.
The Amazoning of retail, for example, are now accelerated around the world. Meanwhile,
migration to the cloud, more remote working.
That's right. So Microsoft's done well.
Video conferencing,
Zoom's done well. So a lot of those stocks have done very, very few have done poorly. They're all up to 50, 60, 80, 100%, including Australia, but Australia's got a tiny sector.
Yeah.
That's the difference. It's the weight of those big sectors of healthcare and tech in the rest of the world, in the US particularly, that's led those markets, and the weight of our banking systems dragged us back in Australia. And also things like retail, like property trusts. Australia, about 7% of the market here is property trusts, whereas globally it's about 2%. And they've obviously done very poorly this year. So that, again, is another factor that's dragged the Australian market down.
Yes. Now, in your monthly report, you also went on and did some analysis on the economic recovery. So, here previously we've been talking here share market recovery, and we know typically share market recoveries lead economic activity. But you started to do some analysis and say, okay, well, we've had significant contractions, as you'd expect, in early to mid 2020 as the lockdowns took effect. What are we seeing now as some parts of the world open up and economic recovery begins to take hold?
Yes, the shares, generally speaking, lead economic indicators. Shares tanked and pretty much always tank before recession or early in the recession, and shares almost always, in the case of Australia, pretty much always except one over the last century, have always rebounded very strongly in recessions while the country's coming out of recession. So it's while dividends are being cut and companies are reporting losses, which shares do very well and always have done through all recessions going back in Australia's history. So that was, we wrote about that extensively earlier this year. That was expected. So when companies were reporting, in Australia, we went from $75 billion profit total for Australian market down to about $40 billion profit.
Yes.
So it literally almost halved. Meanwhile, shares have pretty much doubled in that period because, or in many cases doubled, because investors are looking forward to the rebound in profits next year and a continuation of the path in the future years. So shareholders or investors are looking forward, whereas company reports are always looking past, and economic numbers always look past. So that's the disconnect between what's happening on the economic front and what's happening on the share market front. So one of the things I make a point of, the GDP numbers, which is the total economic pie growth numbers in the world, most countries use completely different methods to measure GDP growth, which after all that's the big number. That's the thing that describes the whole picture of a country, and indeed regions in the world. So various countries like the US use wacky methods. So they'll report something like a 25% drop in quarterly GDP, which is just a meaningless number. And then Europe, for example, a week ago reported a 60% jump in quarterly GDP for the September. So they're stupid numbers because what they do is they take a number, they multiply it by 4, they compound it up, and they divide their house number and end up with a ridiculous number that economists sort of get very excited about. Whereas Australia's GDP reduction was like 7% down in the June quarter and then 3% and a bit up in the September quarter. So the 7s and 3s sound like nothing like the 25%.
Trailing annual figure because you're not taking the quarter and annual.
Some of them are quarter on quarter, some of them on quarter on year last year, some of them are on the 4 quarters to this year divided by the 4 quarters last quarter. So it's ridiculous. And China's a different method altogether. So you can bypass all those ridiculous growth number charts, which are literally off the charts, and just track the total pie growing. And if you track the total pie growing, and I'll do that in one of the charts on page 6, you can see, for example, that Europe and Japan over the last pre-GFC, going back till 2007, the total pie in Europe and Japan, which is, after all, more than half the world economy, has basically been dead flat for a decade. and it's basically turned out the light's the last person there. It's a bit of a blip this year, but basically they haven't grown for a decade. Whereas Australia, US is next. US has grown a couple of percent per compound per annum, so the pie is growing, subject to a blip this year. Now the US has come back, will get back to its previous growth curve probably around about next year. So it's another year's left of growth in the US, rebound this quarter, maybe the next couple of quarters.
To get back on trajectory.
To get back on its normal trajectory, which it was for the last 20, 30 years. Australia's even better. Australia's the best country in the world. It's got a young population, it's got a growing population, so the population growth is what's driving us there. Productivity growth is pretty much nil, but population growth is driving that. Our dip this year was quite severe, and we're not even halfway up the dip yet, so we haven't even recovered half of it yet, whereas the US has recovered most of it.
In terms of our economic activity.
The total pie.
Yeah, it's got a long way to come back.
So another year or two of growth, and the December quarter will be probably another 2 or 3% real growth. So that will take us back close to what we were last year, but it's still a year or two away before Australia resumes its total pie growth. Now you need that because that gets jobs. You can only grow jobs if the total pie is growing. And that relies on things like trade to China, tourism, etc. So a lot of things are going on there. But the point is that the pie growth curve is bigger in Australia as it has been in the US, and certainly the flatlining Europe and Japan are basically dead for life.
So what's driving
China.
some of that, I guess? So just before we move on to China, because this European and Japan story is something you've talked about before, and Japan is probably the first country that went through the quantitative easing and the zero interest rates for a long period of time. Other parts of the world have caught up and played the game post-GFC, but really economic, demographic fundamentals that are sitting underneath that, aging population, it's pretty hard to climb. It's pretty hard to overcome that as a force in the economy to get growth.
That's right. So what now? Japan was the great post-war growth story. It was built by Australian iron ore and coal and steel in the 60s and 70s and 80s. So it's a good story for Australia, and we still export. Then still the number 2 exporting buyer that we have. So Japan, we all have a look at Japan and laugh at them because they're dying and they're decaying and they're old and they're aging. It's the oldest population in the world. It's the most aging population in the world, the most rapidly aging. It's also the oldest, highest welfare bills. There's nothing going for it demographically at all. The only solution to that sort of problem is immigration. And Japanese culture is such that nobody goes to Japan to live. If they are, they're expats, they come back. So as a culture, it doesn't accept new people from outside. It never has. It's always been a closed type economy. So the same goes for Europe. The engine of growth in Europe, again, Germany was the growth engine post-war.
Post-war, yes.
NATO as a US ally, built with Australian coal and steel exports and food, etc. So Australia's done very well out of the Europe growth story in the 60s, 70s and 80s. But the same thing, Europe population, if you look at Germany, the Northern Europe is declining population. Germany's declining population, Austria. So those countries, the pigs are actually quite good. The pigs have actually got population growth, which is the Mediterranean country, which with the high debt. But the core of Europe and Northern Europe has declining population. Again, aging population, high taxes, massive welfare bills. Again, the only solution for them. Now, human history for the last 100,000 years is all about migration, people moving. Australia's built on migration. Most countries in the world are built on migration. Everything was empty 100,000 years ago in Africa, and people migrated out of Africa into various countries, and it's still going. So once you realise that migration is natural and inevitable and normal, that's how human societies develop and change. Once you close the borders and you don't allow migrants to come in, that's the only solution for Europe. Europe over the last, particularly post-GFC, has become very xenophobic, very right-wing, very reactionary. So you can't see immigration being a solution for Europe in the future.
Well, they had a crack at it, and it caused a lot of tension.
That's right. Probably Merkel's biggest mistake was her taking on 1 million refugees, which of course is the right thing to do. But GFC, high unemployment, high youth unemployment, radical Islam, skinheads in Germany burning cars. So that environment for accepting and embracing young immigrants with working families like Australia has and has done for 250 years, that's basically closed the borders for Europe. So I suspect that's going to be a trend that will continue for many, many years in Europe. So those two areas, regions of the world...
That's probably unlikely to break that trend that they've experienced post-GFC in terms of fairly stagnant growth.
Plus you've got Brexit occurring. So I suspect that the stagnant growth and ageing population and massive welfare bills and massive government debts will be a problem that Europe is becoming the same as Japan. 30 years of QE in Japan and zero interest rates hasn't done a thing for Japan. Done nothing at all. All it's done is boost asset prices, which is good for us, but doesn't actually create the engine of growth that Japan wanted. Yeah. So Japan's dead and Europe is dead as an economic growth driver for the world. So those two pretty much offset China, which is growing, and the US is growing, Australia, Canada, New Zealand, they're growing. But that lump of Europe, which is 350 million people, is basically stagnant and will be forever. And Japan as well, stagnant forever, which is 134 million people. So they're big numbers.
But I guess from Australian perspective, we've got better demographic situation here, and US likewise. So there are pockets of growth in the world, and it's not...
Big one's China. So if you look at the same chart, while Europe and Japan have flatlined, subject to the odd boom and bust here and there and the odd economic crisis this year, China, meanwhile, has more than doubled in the last 10 years. The actual size of the pie has more than doubled. So not only is that, but we're actually exporting, 10 years ago, we exported 30% of our output to China. Now we export 41% of our output for China, and has been growing rapidly. So that has been a massive engine of growth. Now, China 10 years ago was growing at 10% plus per year. The pie was growing 10% plus. Now it's growing at probably this year 4 or 5 or 6%. That's given the pie is 2.5 times the size. That's still more growth,
monumental growth,
than it was 10 years ago. So the pie is much, much bigger in China, and it's still growing, albeit modestly. It is still very good for the whole. That's lifting the global economy.
So if we sort of then take those two pieces and put them together, we know share markets have rebounded in lots of parts of the world back to where they were, or in some parts ahead of where we were 12 months ago. Economic growth is picking back up, but not quite where it was. Are some of the assumptions that the share markets are making in terms of future earnings getting overly optimistic, overly heroic?
Well, this time last year, global shares in aggregate were trading at around about 20 times profits, global profits. Now, global profits last year was a fraction under $3 trillion US dollars. So that's a lot of money, $3 trillion profit pie. And shares were trading at around about 20 times, which is very expensive. You don't want to pay 20 times profits. So you're at the top of the bull market when you're paying 20 times global profits.
By historical measures.
By historical measures. Then you got the COVID crisis, everything collapsed, and the lockdowns, and of course global profits went from $2.84 trillion, $3 trillion, to less than $2 trillion. So we lost over $1 trillion of profits over the last year. Now, it's a moot point as to whether that's out of the woodwork yet. If the virus is if the vaccine's fine, everyone gets it, everyone's back to normal, then maybe there won't be more losses occurring. But probably there's going to be a few bumps left in the road. So last year, share markets companies produced $3 trillion in profits, and investors paid 20 times that for the share prices. Now, profits are 40% lower, at $1.8 trillion. And we're paying, and the share price is pretty much where it was last year. In the case of the US and most of the rest of the world is above, but let's say it's square. So we're paying now 40 times this year's earnings.
It's all about what they're assuming.
So the assumption is, this magical V curve, the assumption is that, okay, we write 2020 off, bad year, we know that. The assumption is that same magical $3 trillion profit we had last year would reappear next year.
Yes.
And that's a big ask. And even if that's the case,
V-shaped recovery in the
even if that $3 trillion magically reappears in profits next year, today's share prices mean we're still paying 20 times that. That means that a 20% PE multiple means that you're expecting at least another, double-digit growth after that to continue that justifies our 20 times earnings. So the question of whether that $3 trillion profit down to $1.8 trillion profit will rebound to $3 trillion. So if you look at where it is, banks in the world make up about 15% of world market value of shares. 30% in Australia, it's unusual, but in Europe, US it's tiny, most of Asia it's quite large, most of the emerging markets it's quite large, but banks only make up about less than 1/6 or 1/7 of the share market value by share prices. Banks, on the other hand, produce about 40% of the world's profits, even now when profits are down 50% for bankings around the world. So even though banks are a smallish sector of the overall market by pricing, they still generate around about 40% of all profits for all companies in the world, about 20,000 companies we track. Now, if you look at the pricing based on the big banks around the world in the big markets, they're only expected to generate around about a quarter or a third rebound of what profit they lost this year, which is actually quite good. We haven't had this massive flood of or tidal wave of bad debts and corporate bankruptcies. A lot of that's to do with support governments have given. I suspect that if we get the virus vaccine out there and it starts to be progressively used, I suspect that given the stimulus from central banks and banks, I suspect that you're not going to get this massive tidal wave. You've got the odd Virgin Airlines going down and the odd company going down, particularly retailers in the US going down and in the UK and Europe. But I suspect you're not going to have this mass bankruptcy. Remember in the GFC, every single day in the paper, another bank collapsed. There was a cascade of bank collapses every single day. Bailouts. This time around, you've got the governments and central banks much more supportive. So if we don't get this massive tidal wave of bankruptcies, which is probably not our base case, then you're going to see banks probably recover some of the losses they lost this year, which is actually, so the banking sector, which is 40% of all profits, that's actually quite reasonably priced, and they're cheap to start with. You look at the other sectors, healthcare is quite a major sector, and healthcare has basically boomed through this. Most healthcare companies have pretty much ignored the virus crisis and, in fact, increased their sales and their revenues and profits in most cases. So if you look at a sector I break it up sector by sector around the world for 20,000 companies, and you see that even though we're forecast to generate an earnings per share of profit growth of about 20-30% in the rebound next year, sector by sector, country by country, that's actually, there's a few areas you question mark, but most of those are reasonably achievable, assuming the vaccine's out there next year and things reopen slowly and carefully.
Reopening of the economies.
So I suspect even though the profit's gone from 3 trillion to 1.8 trillion, which is radical, and we're now paying 40 times those earnings, I suspect that there's still quite a lot of upside left in the profit picture next year. And if you look at it sector by sector, country by country, most of them are not stretched, not unreasonable. It doesn't mean there's not risk in the world if another virus, a completely separate virus breaks out. There's all sorts of things that can go on. But the pricing at the moment is expensive, not a lot of room for error, but things certainly aren't cheap. But I suspect that most of the profit rebound next year is pretty much achievable.
Okay. And also, I guess the other key factor is in an environment where interest rates are increasingly nailed to the floor, people are more willing to be optimistic and discard next year's earnings or even the following year's earnings.
The other thing is oil and gas sector, which is quite a major sector around the world. They were producing last year $250-odd billion in profits, total profits. That went to about a $200 billion loss this year. So that's $500 billion turnaround from profit to loss this year, get negative oil prices during the year, which caused every company in the world to have losses, including Australian oil and gas stocks. So that's $500 billion of profit taken out of the picture this year. That negative oil price we saw in April, I suspect my base case is that OPEC, Iran, Russia, US, the big players, I reckon that the sight of that negative oil price shocked them into saying, we will never do this again.
Not let this happen.
It was self-inflicted. It was basically production cuts they let loose. They had a pricing war which went mad, and they had negative oil prices. So it's one of the few markets where they can control. It's a cartel. They can set the price every day if they want to, and they are. So since that negative sight in April, negative oil prices, they've actually restricted production and said, look, let's not get crazy. Let's stop the price war and let's get the oil price back up to the $40, $50, $60 range, which is good. It's a nice sweet spot for the world. If that occurs and stays, which there's no reason why it won't stay there. Meanwhile, you've got global growth demand rising as well. I suspect that will go from a $500 billion turnaround from profit to loss this year. The forecast is it'll come back to zero profit next year. Probably pessimistic. You probably see a better profit in the oil and gas sector. Yes. So if you add up all these sectors, the total pie looks achievable to go back from $1.8 trillion profit this year to probably above $2 trillion next year, and then growing from there on.
Get back on trend from there.
So the numbers sound good in total, but if you scrape below the surface and see what's actually driving those and take it sector by sector, part by part, you see that there's a bit of pessimism already in the market, and probably those profit numbers will be achieved.
Okay. Well, that's heartening. And when we talked before about, I guess, the outlook for Australia, the key there is 40% plus of our export revenues coming from one trade partner. Now, tensions with that trading partner have certainly been leading to flashpoints in recent weeks. We've had issues over lobsters and corn,
everything
and,
else, yeah.
Wines,
food, wine.
Yeah.
Our biggest exports are iron ore and coal comes in two flavours. You have coking coal, which is used to make steel, and you have thermal coal, which is used for energy production in power plants. China was built all these new bridges and buildings you see around China. Most of the coal and steel, the coal and iron ore, to make all those bridges and airports and what have you, come from Australia. Most commodity prices, industrial commodities, have been falling over the last couple of years with a global slowdown, with one exception, iron ore. You had this massive mine disaster a couple of years ago in Brazil, Brazil was the number one exporter of iron ore to China and our major competitor. A whole bunch of disasters, plus you had the COVID lockdowns, basically stopped the Brazil trade of iron ore. Did two things. It gave us a windfall price growth from what was $20 in 2018 back up to $130 or $40 today, which is a massive increase in iron ore prices, nearly what it was in 2011, $180. Plus you've got volume. We're getting what Brazil was exporting. Pilbara is now the number one exporter to China. So the volume and the price growth from the Brazilian disasters was just double windfall.
It's given Australia a major economic shot in the arm as well.
So you find all these closed and boarded up iron ore mines in the Pilbara, which have got high cost and low grade mines. They're all being reopened now to try and take advantage of this. So supply will catch up, but I suspect that the Brazil closure, they announced the other day that the closure is going to last longer because of COVID restrictions and problems, operational problems. Of course, the iron ore price jumped another $20 from 120 to 140. So the danger is for investors to see those as normal. They're not. Iron ore price should be like $50, $60, and we're just making hay when the sun shines.
It's a supply side pinch.
Coking coal is similar. So there was a story in the AFR, I think it was a couple of weekends ago, where they interviewed 25 prominent Australians, from trade to politics to exporting to all sorts of things, what Australia should do. And the overwhelming headline was, just shut up.
Right.
Basically, shut up and take the money.
In terms of how to manage the situation.
Shut up and take the money. That was not my words. That was the headline of the AFR, summarising 25 commentators. So it is hard to shut up and take the money. The difference with China is that it is a strategic enemy. Australia is the American sheriff in the south. Japan is the American sheriff in the north. And our job is to look after US interests in the world and in the region. And that's been the case since the fall of Singapore. So Australia has got to make hay while the sun shines. China would love to and has been actively trying to get extra supplies of iron ore. Things like wine, barley, beans, lobsters is not important. They're not strategic. You don't build tanks with lobsters. You build tanks with iron ore. Where does it come from? Australia. They have not got any other source of iron ore in the world. The Belt and Road Initiative is there to create markets and create sources and create influence for China.
Create allies.
They've got all over Africa now. You see Chinese workers in Chinese mines, Chinese construction. So Africa's a big target. South America's a big target, and one of the things they're looking for is sources of iron ore. So far, they haven't got it. What they are doing is they're buying into Australian companies. China is the biggest owner of Rio shares. China is the biggest owner of Fortescue shares, and they would like to increase their take. Every year, companies are sold outright to China. So they've got their foot in a couple of pies here. They're actually buying up companies, buying up operations, buying shares in Australian companies. But ultimately, the Australian government can stop exporting, which it won't. It's got to shut up and take the money. Or China can stop importing. In the case of iron ore, they'll only do that when they've got an alternate supply. They've got to build these islands, these bases, these tanks, these ships, and they can only do it with Australian iron ore. So we are fueling our enemy in the same way which we sold. If you look at the charts for exports to Australia, which I've actually got, since 1788. I've got a chart of where we export to
Yes.
countries around the world.
It's on in your latest report.
We had an export boom to Germany prior to the First World War to build their machine. That attacked us. US stepped in as our major supplier. So US bought our exports that Germany had bought. Second World War, we had a major export boom to Germany, Italy and Japan to build the tanks that invaded China and eventually the rest of the world. Second World War outbroke and US stepped in as our number one export partner. So US being our parent, our mother country used to be England.
Ally.
Now it's US. US stepped in both the First World War and the Second World War and Vietnam and Korea to take our exports when we had to declare war. Now, war's a long way off, so we're not going to worry about war. But right now, China...
Cold War-like activities.
It's Cold War. So I can see us being in a Cold War like the 50s, 60s and 70s and 80s, where you have this build-up. At the same time, you've got the anti-globalization. You've got the world resorting to trading blocks versus global trade. So, and this is post-Trump. I mean, this has happened before. Started before Trump. Trump accelerated, but it's not something that Trump started. He simply rode the wave. So I can see the world heading into a Cold War, military build-up, all of which is good for commodity prices. If and when a war breaks out ever, which it may not do for decades to come, then we'll have to say, right, we're going to stop exporting to X, Y, and Z if we're depending on who our allies are at the time. Don't forget that China was our ally in the Second World War. They were our friend. Japan was the enemy. Now, Japan's the ally and China. So there's nothing inherently fundamental about the relationship. It's very practical. On the day, we'll decide who our ally is. Right now, ally is US, enemy is China. In 40 years ago, it was the reverse. Now it might be different in the future. So in the meantime...
The reality is we're going to have to get used to this for years and decades to come, realistically, as the jostling continues.
The good thing is CEOs have, I think, finally been kicked into realising that they cannot have one client. Now, when we're exporting to Britain or US or Germany or UK, our exports consisted of a whole bunch of stuff and each company was buying it. You're dealing with 1,000 clients. May well be in Europe and UK, but there are 1,000 clients. They made independent decisions. Yes. When you deal with China, you deal with one China's Politburo, and that Xi Jinping is an emperor for life, and he, on one stroke of a pen, can stop all exports of anything, if you like. So you're not dealing with 100 companies in China. You're dealing with one Chinese Communist Party.
Central buyer. So
if you're a wine producer, like Treasury Wine Estates is a great company, but 40% of its wine goes to China, which is crazy. So it's finally kicked Australian companies, I think, into realising
the strategic risks.
So what I'd like to see, companies in Australia succumb to shareholder pressure to pay out dividends rather than reinvest. I would like to see lower dividends. I'd like to see higher retention of earnings and to go and develop markets in Europe and Eastern Europe and Middle East and India and other parts of Asia and Africa, try and develop other markets for our products.
Diversify away
not
from the
just
central
a
risk.
Simple thing, sell to China, go to sleep at night. So I think this episode has kicked a lot of CEOs awake and they've got and boards to try and change their focus to try and diversify away from China for their own sake, not just
of a strategic export plan across the world.
Meanwhile, make hay while the sun shines and shut up and take the money.
Yeah. And as we near year end, your one X factor that you mentioned last month was that President Trump might not vacate the White House. He's making small moves to indicate that he might just have to.
Well, I was having a long conversation last Friday for about 2 hours with an Aussie who's a smart fellow who was still convinced that Trump, one, has been dudded and there's been fraud on a mass scale. So there are still people. Don't forget,
there are true believers out there.
There are of the 74 million people that voted for Trump. Some of those can read all right. Some of them are just mad Trump voters. But I suspect
it depends what you read, and if you only go to your own particular media source and read it every day, then you keep drinking the Kool-Aid.
A lot of Republicans say, "Look, we don't like him, but we've got to vote for low taxes and sport," which is fine. So there are Republican voters who will just vote Republican, but there are a rabid rump of people who still believe. So he could do a James II 300 years ago and basically set up an exile in some foreign. He's got to get out of the US. He's been sued by too many states, so he can pardon himself and his family, but he can only pardon himself for federal crimes. He can't pardon himself for state crimes. So he's got to get out offshore, and he may well just buy an island with borrowed money from Deutsche Bank, Hitler's bank, and set up a court there, and he could operate and plan his he operate as a separate court as an exile president and come back in 2024.
You're really taking this theory up a notch. So last month he was not going to leave the White House. Now he's going to set up the Democratic Republic of Trump.
I would like to see.
Actually, it's not going to be Democratic at all.
I would like to see how many forklifts are required to get him and his hair out of there. It's going to be funny. It's going to be funny.
Live.
Who needs comedy when you got Trump?
And January brings end of quarter investment outlooks, review of the asset allocation. Anything that you're seeing, and as you begin to do your monitoring into the year end, that's beginning to foreshadow how portfolios might be positioned into 2021.
So just a reminder, we are bullish on shares. We have been since the middle of the year. We are a bit overweight global shares, which have done very well, which is more than half is US, and US has done very well. We've got emerging markets, which have done well as well. We're still, I think, fully weighted on Australian shares, so we're still moderately bullish on Australian shares, noting that they're very expensive and they require this magical rebound of profits, which we're looking very closely at. We are underweight fixed-rate bonds because of the inflation risk over the medium term, and don't forget bond yields have been rising in the US and Australia for the last 2 or 3 months on this idea of a recovery and maybe inflation in a few years. So we've got high-grade floating rate funds in there as well, but mostly in shares. We'll look at those again in the beginning of January, and we'll sit down again in the January meeting. I don't see anything radical on the horizon, but we'll have a look and see. Shares are expensive. We'll look at the sectors and the country mix and the regional mix, but so far it's playing out well, albeit at the expensive end of town. And we'll have a look and we'll make some adjustments in January, but I can't see anything radical coming up, but watch this space.
Okay, excellent. Anything else you'd like to leave us with before we?
No, I think the Trump and the forklifts is all I can give you.
Watch this space.
Watch this space.
Watch this space. Wonderful. Well, thank you very much, Ashley, and a huge thank you to all our listeners, and I want to say a special thank you to all Stanford Brown clients for your support through what has been a pretty challenging year for many people. I hope everyone has a very happy and safe Christmas and can spend as much time with their families as possible, get the rest that we all need, and look forward to doing it all again in 2021.
Best of luck. We will.
Thank you.
Thanks.